Hi everybody, this is AJ speaking. VW Group published a few days ago second quarter results. This presentation is a deep dive to see what we can learn from them and what could be the potential trading opportunities here. But first a quick recap. So VW Group is the second largest automaker globally by number of vehicles sold, but the largest automaker by revenue. The number one is Toyota, but VW Group's average vehicle value is significantly higher than Toyota's, because Toyota sells significant number of lower cost vehicles. So on this first chart, you can see Volkswagen's or VW Group's long-term share price development. This goes back to all the way to 2000. And you can see that the company had two major peaks in share price. The first in March 2015 when the stock hit €250 per share. And then exactly 6 years later, the stock hit again 240 after dropping in the interim below €100 per share. So this is quite volatile, and where you find volatility, there is opportunity to both the upside and downside. So if we focus on the shorter term development from the recent peak in March 2021 to the current share price, so there was a 61% drop down to just under €94 per share right now. Since this is quite a long period, this is over 4 years, this doesn't look like all too impressive, and for that reason we need to zoom in a bit more. This is what this second chart does. It's again VW Group share price performance or development, but this time we just look at it over the last 12 months. The stock is down 10% over the period, also not too exciting, but it's down 15% just from March. The beauty about Volkswagen Group is there's a lot of disclosure, number one, and number two, you can trace Volkswagen Group's sales development, and this gives you a heads up in terms of how the company will perform financially. On top of that, Volkswagen Group is highly concentrated in specific markets, and typically when you do a deep dive in these specific markets, you also get a good leading indicator on the performance of the group. For example, Volkswagen Group's core is Germany, where the company has about 40% market share. The extended core of the group is Europe, where it has also dominating market share of nearly 30% and has been growing. So in other ways, you can play Volkswagen Group based on the company's performance, but also as a macro play on Europe and Germany. So if you have a bearish view on Germany, Volkswagen Group is one way to short Germany and vice versa. So with that out of the way, let's dive into the financials. Here a quick look at the table of contents. There are 38 slides I want to discuss, so I would have to move relatively quickly. And this presentation is not meant to be a comprehensive rundown. This is focused on some key aspects that I want to discuss. For example, one big topic that's missing from this presentation is a discussion of geographic sales performance. But I've discussed this ad nauseum before, so that's why I skip it in this presentation. So here on this first slide in the main presentation, you can see the group's total revenue development. Revenue is down 3% in the second quarter, and the first half is down 0.3%, so broadly flat year on year. But always keep in mind inflation. There was inflation globally. This means if revenue grew at, say, 0% year on year, in reality, the company became smaller. That's why when you look at companies like Volkswagen, what you want to see is at a minimum a growth rate that is at the inflation rate. But ideally, of course, you want to see a multiple of the inflation rate, of course, because that would imply there is real growth. The problem with this chart is it's quarterly, and you can see there's a lot of seasonality going on. There are various peaks and troughs. So that's why I always recommend to look at these metrics also on a trailing 12 months basis. This is what this chart does. And you can see as we came out of the, what I would call COVID recovery, Volkswagen delivered some attractive year-on-year growth. But effectively since Q4 2023, the company's growth has been muted. And you can see it on the quarter-over-quarter change rates up here. So after Q4 2023, the trailing 12 months decreased slightly from 344 billion to 343 billion. Then slightly increased, slightly decreased, So broadly stayed in the same range. But keep in mind, this is over a 2-year time period, and there was quite a bit of inflation, so the company became smaller over this period in real terms. So that's the first observation. VW Group is shrinking and has been shrinking for several quarters. Now let's look at a major driver, of course, in Volkswagen Group, which is vehicle sales. Vehicle sales paint a slightly different picture. Vehicle sales were up 0.1%, and in the first 6 months of this year, vehicle sales were up 0.5%. And you can already see by the discrepancy between total revenue development and vehicle sales volume development that vehicle sales are not really a good metric. Now we need to talk about some very important accounting point. So when you look at VW's income statement and you go from top to bottom, you go from revenue, cost of revenue, operating expenses, and then you arrive at operating profit. The sales that you see in front of you, these vehicle sales, they do not correlate with those income statement numbers. And the reason is a very large chunk of these vehicle sales relate to China JV sales or China joint venture sales. And all sales through these entities, so these joint ventures, are accounted for what's called at equity. That means none of the revenue, none of the cost of revenue, etc., flows through VW Group's income statement above the operating profit line. VW Group accounts for them as a one-line adjustment below the operating profit line. So that's very important. So these almost 2.3 million vehicles that you see here for the second quarter do not circle back to the revenue numbers that we just looked at. That's why we need to strip out these JV sales. And this is what this next chart does. This chart shows you total VW Group vehicle sales, excluding China JV sales. And these numbers now circle back or correlate with the revenue numbers, cost of revenue numbers, etc. And that number came down by 0.8%, and Volkswagen Group, excluding these China JVs, sold 1.63 million vehicles. And the first half of this year is up 1.5% to 3.1 million vehicles. So that's still quite a lot. But you can see the vehicles Volkswagen Group makes, and when you look down here at the full year number, was 6.3 million in 2024. And when we go back to the prior analysis, the total reported was 9 million. So when people always talk about Volkswagen, they always talk about the company as a 9 million or 10 million unit vehicle seller. That is not true. Volkswagen is just selling over 6 million vehicles. I mean, this is still a lot of cars. But the fact that around 3 million vehicles are sold through JVs is a significant factor that should be considered. So this chart looks at how many vehicles the JVs make. And you can see that in 2024, this was just over 2.7 million vehicles. This number came down almost 11% from 2023. In 2023, these JVs made just under 3.1 million vehicles. And in 2022, they made over 3.1 million vehicles. I explained before why that is. VW used to be the king of the Chinese auto market. They were the first large Western automaker to enter the Chinese market. They were extremely successful. At one point were dominating the market by a big margin. But all this market dominance has all gone away, and VW Group entered into what I would describe a terminal decline in China market share. And this is also something I covered in depth previously, so I will not go into this topic in this presentation. But the bottom line is the China market is only downhills for VW Group at this point. This chart shows you then the contribution from China JVs and the rest. And you can see how the contributions are in percent to total vehicle sales volume from China JVs has seen a long-term downward trend. And this trend line in red mix is very clear. So the bottom line is when you analyze VW Group's revenue, etc., you need to, and you want to compare this to unit sales, etc., you always need to strip out these China JV sales. Next, we need to talk about the difference between what's called deliveries and vehicle sales. So deliveries is what people would generally assume. An end consumer takes ownership of the vehicle, or you might call it a real sale. But this does not matter to VW Group directly, because VW Group's end customer is not the consumer, it is a dealership. And sales to dealerships are called vehicle sales. Vehicle sales relate to revenue, but again, excluding JV sales, and vehicle deliveries do not directly affect VW Group's financials. Of course, if deliveries decrease, at some point VW Group cannot recognize more vehicle sales to dealerships because the dealerships would overflow with supply. So therefore, you always need to look at both. And this is what this chart does. So up here you see per quarter deliveries to customers. So let's call it real sales. So the underlying number. And then for that same quarter, just above, you see the vehicle sales, so the number that correlates with revenue, etc. And then the chart itself always takes the delta of these two numbers. And you can see in the most recent quarter, VW Group recognized 19,000 vehicles more than what was actually sold that quarter to end consumers. That is actually a very small amount of over-recognition given the large scale of VW Group. So that is not the interesting observation of this chart. The interesting observation is that you had, when you go back to 2022, you had a consecutive build-up of inventory. So you have every quarter positive numbers and relatively large numbers. So in the first quarter of 2022, there was an excess recognition of 97,000 vehicles. So that quarter, VW Group delivered 97,000 vehicles more to dealerships than what the dealers could sell that quarter. And this was part of the COVID recovery. And in my recent General Motors deep dive, I explained how that worked and why this was a one-off windfall cash profit opportunity for the automakers. So what they did is they not only sold the vehicles that were sold by the dealerships, but they also sold an additional amount each quarter that would serve to replenish the dealer inventory. So they had these two sales drivers, and this supercharged the financials. But this had to come to an end, and the end was when the dealers were full with cars. And when you look at this chart now, you can see basically when this happened. This happened at the end of 2022, beginning of 2023. This was the last time when there was a significant over recognition. And then VW Group had to dial back the delta between what the dealers sold and what they delivered to the dealers. And this is why you then had this, let's call it fluctuating pattern, sequentially from one quarter to the next, where you see there was inventory drawdown and inventory buildup. And the box that you see that is across these 9 quarters, the total of these positive and negative numbers is just 5,000 vehicles. That shows you that VW Group held the global inventory basically constant. And for that reason, we can pinpoint as the quarter when the inventory was full as the first quarter of 2023. And I call this when the COVID honeymoon for the automotive industry ended. I think contrary to popular belief, COVID was actually a godsend for a lot of automakers, and in particular those automakers that were oversupplied with vehicle inventory. This was the biggest boon in a long time for these companies. But this was all a total one-off, and therefore their decline subsequently was totally predictable. But before we move on to profitability metrics, let's have a quick look at VW Group's battery electric vehicle deliveries. So these are real sales, and the second quarter of 2025 was up almost 38% year over year, and VW Group sold a respectable 249,000 vehicles. This also meant that VW Group for the first time ever crossed the 11% EV penetration mark. So in the second quarter, 11% of total vehicle sales, or deliveries I should say, were fully electric. Just to put this into perspective, Toyota is below 2%. So VW Group is significantly ahead of Toyota, which is VW Group's technically closest peer. But the issue is that was still not good enough. And by that I mean VW Group lost its number 3rd position in the global battery electric vehicle sales ranking. VW Group used to be the number 3 just behind BYD and Tesla, but now Geely is ahead of VW Group, although just by a little bit. And I'm sorry, I know it's really hard to read, it's a very small font, but you can see by the latest sales trend, and that's why I'm showing these numbers also on a quarterly basis. You can see that the latest quarter, Geely delivered 272,000 vehicles, VW Group only 249,000 vehicles. So there's a significant outperformance, even though the last 12 months performance is almost the same. Geely's at 900,000 BEVs and VW Group at 893,000. So there's only a 7,000 vehicle delta. But because the latest quarter was such an outperformance, we can fairly safely assume that VW Group will not be catching Geely in the next 2 quarters at least. And likely or possibly never. But before we move on from this global EV sales ranking, there are a couple of quick key observations. Number one, we have a very large concentration at the top. BYD and Tesla account for the majority or for a significant share of total sales. Then we have a second tier, that's Geely and VW. I think BMW is debatable at 456,000 sales and are probably best classified as a tier 3 at half of VW Group sales at number 5 spot. And then in this tier 3 group, we have a number of companies that sit somewhere in the, let's call it 150,000 annual BEV sales rate to 250,000. What this chart doesn't show is the fact that a lot of these companies do not directly compete against each other. For example, the North American automakers are mostly shielded from Chinese products. So is the European market. And China is so competitive that basically all American automakers except Tesla gave up on that market. And the European automakers, the few remaining, continue to lose market share left and right. I expect that the Europeans left in China will also relatively soon take significant restructuring charges, just like we saw last year with General Motors, which, by the way, I totally predicted. I posted about it in September, and then I think a month later, General Motors announced the restructuring. The reason why I was able to predict it was I saw how the sales of GM's JV partners in China, especially SAIC, totally collapsed, and therefore a major restructuring was totally unavoidable. Side note, SAIC is also a major partner of VW Group in China, so their restructuring is just a matter of time. So with that out of the way, let's talk about gross profit. So a quick recap: gross profit is what's left after you deduct from revenue the cost you incurred to generate that revenue. It does not include R&D expenses. It does not include other types of overheads like SG&A spend, so selling, general or administrative expenses. I'm slightly simplifying, but this is how it works. So let's look at gross profit in the second quarter. It's down almost 14% to $14.5 billion. The first half is down almost 10% to $28.2 billion. The important thing you have to know about these numbers is number one, VW Group reports under IFRS, so you can't directly compare it to US GAAP numbers. They're very, very similar, but the big one is number two, is that VW Group includes R&D spend in gross profit. So gross profit includes the cost of R&D and therefore is lower than the gross profit of, let's say, comparable automaker that does not include R&D expense in cost of revenue, i.e. above gross profit line. For example, Tesla includes R&D spend in operating expenses, and therefore the gross profit is shown higher than in VW Group's case. So that's why whenever you compare these automakers, you always need to adjust for that to put it on an apples-to-apples basis. I prefer disclosure the way Tesla does, because in my view, R&D should be in operating expenses, not in cost of revenue. And over the last couple of years, more and more automakers moved to that type of disclosure, and I think that's the, I would say, state of the art of disclosure, moving R&D into operating expenses. But there is more to VW Group's R&D spend disclosure, but we'll talk about this later, and it's a quite important point. Next, we look at the implied gross margin. Again, because of R&D spend inclusion, this reported gross margin is, let's call it depressed. But we look at it in a moment what it would look like on an adjusted basis. So if we add back these R&D expenses, so let's just look first at the reported headline number. Headline number came in at 16.8%. That's down 2.1 percentage points year on year. Last year it was at 18.9%. You can see the first half is down 1.8 percentage points, came in at 16.7% gross margin. And you can see that there's a material sort of volatility in VW Group's gross margin. That's why we need to zoom out a bit. This is what this chart does. You can see in red the trend line, and it's clearly trending down. And then at 16.8% for the second quarter, this is the weakest gross margin in several years, as you can see, except for significant force majeure events, so significant one-time negative events, like when COVID shutdowns hit, or when factories had to be shut down due to chip shortages, etc. So then let's look at gross margin what it would look like if you would adjust for R&D spend. So you add back R&D spend, and as you would expect, gross margin materially increases. And this is actually why VW Group is not losing money left and right. I mean, the numbers are not great, but it's not like the company is going bankrupt tomorrow. And the reason is the gross margin is still relatively healthy at 22.6%. For example, Tesla's gross margin right now in auto is roughly half. But there's a long list of reasons why that is. Number one, VW Group is a ginormous company with 350 billion in revenue. That gives an enormous purchasing power, bigger than Tesla's. They've been making cars for a long, long time, so a lot of their land, factory, etc., they're all written off. VW has a very large legacy fleet, which Tesla doesn't have. I mean, Tesla's fleet is growing very quickly, but in terms of relative to vehicle sales is nowhere near to where VW Group's old and established fleet is, and the fleet provides a consistent stream of very high revenue, very high margin revenue. And there's a bunch of other things I could go through, and all, not a single one of them, but all in terms of the cumulative effect, provide large automakers with a significant gross margin advantage. Next, we move on to operating expenses, but before we do so, just a quick note. The first part that you just listened to, I recorded about 6 weeks ago, but I never managed to upload that part of the video. And that's why you see down here the date has changed now. So now we look at operating expenses. VW Group significantly cut costs. Operating expenses decreased 5.4% year over year and quarter over quarter by 1.6%. The first half of 2025 is up 2.1% still to 21 billion. That's because the first quarter saw a significant year-over-year increase. Next, we look at operating expense efficiency, so operating expenses divided by total revenue. You want this number to become smaller over time. And in the second quarter, that number was at 10.8%, so 10.8% of revenue was spent on operating expenses. That is up year over year from 10.4%. In other words, VW Group became less efficient. Also, the first half of this year is slightly less efficient at 11.0%. That's an increase of 30 basis points. And you always want to compare these numbers on a year-over-year basis. So when you look at all the Q2s that you can see in this chart, the current Q2 efficiency of 10.8% is actually the lowest since the Q2 of 2022. And remember, that year was still significantly affected by COVID and various supply chain issues. Next, we look at the end result of all the key metrics we already discussed. So when you take revenue, you take out the cost of revenue, you get to gross profit. Then when you deduct from gross profit all the remaining operating expenses, which include, in VW's case, SG&A expenses, you get to operating profit, which is a key metric for every automaker. It's arguably one of the top 3 metrics one should look at. And you can see that VW Group's operating profit decreased by 29% year over year in the second quarter. And the first half is down almost 33% year over year. And you can see that when you look at this chart at 4.09 billion, that was the lowest operating profit in several years. And you can also see that the first half of 2025 was the weakest first half also in several years. Then when we look at operating profit in terms of operating margins, so operating profit divided by total revenue, we see a similar picture. Operating margin decreased to 4.7% in the second quarter from 6.5% last year. The total operating profit margin for the first half is down 2 percentage points to 4.2%. That's a quite substantial decrease from last year. And when you remember from the first part of this presentation, when we talked about when the COVID honeymoon period was over, as I coined it, you can see that that marked the peak. Please ignore that 13.3% over here. There was an outlier due to a certain one-off effects. So basically, this performance trend correlates, when you look very closely, highly with the end of the inventory replenishment that I talked about in the beginning of this presentation. And I described it as there were 2 growth drivers. One, the sales to customers, the normal sales, but then also the second growth driver was the excess sales to replenish dealership inventory above the normal level of sales. And these factors combined drove the significant outperformance. but it couldn't last, and it is basically what you see in the subsequent years. Next, we need to talk about where the underperformance is coming from. People, of course, think of VW Group as a large automaker, which is obviously correct. But VW not only has its automotive business, but there's also a quite significant financial services business, which mostly deals with all the customer financing of the auto business, that not only includes retail customers, but also significantly dealerships. And that part of the business is actually quite meaningful in terms of operating profit contribution, as you can see on this chart. So for example, the automotive business, operating profit in the automotive business was down 39% in the second quarter, 54% in the first quarter, for the first half being down 45%. However, the financial services business was up 19% year over year in the first quarter, 61% in the second quarter. For the first half, up 35% to 2 billion. This means that just under 1/3 of operating profit in the first half came from the financial service business. And when you think about a business, what I would recommend, don't look too much at volumes or revenue. What you want to look at is operating profit contribution. And based on that metric, VW Group is a roughly 2/3 automaker and 1/3 financial services business. Of course, what makes VW Group's financial services business different from, like, let's say, a pure play bank is that VW Group's financials business is driven by the automotive business. So a delta between the two's performance cannot exist for too long. For example, if VW's automotive business was to basically go away, it's unlikely that the financial services arm could sustain its performance. Of course, it's just a theoretical consideration to illustrate the concept. It's unlikely to happen anytime soon. So now let's dive deeper into the automotive business to find out what exactly caused the underperformance, because VW Group is a very large operation, has many different brands and that are quite different. So first, let's break it down high level. So the automotive segment can be split into the large passenger vehicles business, you see here on top. And then there's the commercial vehicles business. You can already see that the passenger vehicle segment is substantially larger than the commercial vehicles business. But the commercial vehicles business is still quite meaningful. You can see this down here. So it contributed 1.3 billion in operating profit in the first half. And it's about 28% of total operating profit in the automotive business. So now when we look at both, we can see in the first half, passengers business was down almost 39%, and this is also in line with the commercial vehicles business, which was down slightly over 39%. So the underperformance in the first half was quite comparable. However, where we do see a difference is when we look at the quarterly performance. The passenger vehicle segment was down 28% in the second quarter, while the commercial vehicles business was down 41%. So while we saw improvement or slight improvement quarter over quarter in the passengers business, we actually see continuing quite substantial weakness and increasing weakness in the commercial vehicles business. So if we just pause here for a moment and just summarize, so overall we saw that in terms of operating profit, VW is slightly over 2/3 automotive, and then within automotive, the passenger vehicle segment is by far the largest, accounts for about 72% of automotive. And when you express within the automotive segment, the passenger vehicle segment's operating profit as a percent of total group, so including financial services business operating profit, you get to about 66%. So let's call it 2/3. So 2/3 of VW Group's business is passenger vehicles. So for that reason, it's objectively the key driver. But of course, that probably doesn't come to a surprise to anyone listening to that. But what might be surprising, that it is, in quotes, only 2/3 and not more than 2/3. Given that probably most people associate VW Group just with passenger cars, not really much else. But since the passenger segment is so significant, we should dive a little deeper to see what is exactly driving the underperformance of that key segment, especially given that the company is so diverse in its brands, etc. So this is what this next slide does. So if we scroll down, so we can see it more clearly. So the passenger vehicles segment can be split into what VW calls core, progressive, sport, and other. So the core, and VW calls it brand group, core comprises, and I put some notes over here, the famous Volkswagen brand, so all the Volkswagen branded vehicles that you see on the road. Then Skoda is a brand that is mostly sold in Europe, not so much in North America, or not at all. Then there's the Seat and Cupra brand family. Seat used to be a Spanish automaker, and they have a sporty sub-brand called Cupra. And then we have VW commercial vehicles. These are not large trucks. These are delivery van type vehicles. And they're quite popular in Europe amongst tradespeople and other professions. Then we have the progressive brand group, which includes the Audi brand, Lamborghini, Bentley, and Ducati. Ducati is a motorcycle maker. Then the sport brand group only comprises of Porsche. Porsche is a listed company, but VW Group holds a controlling stake, and for that reason in VW Group's accounts, Porsche is fully consolidated. That means that VW Group basically adds all of Porsche's financials in full to its group accounts, and only after the total net income line deducts in the what's called a non-controlling interest, the share that is not owned by VW Group. And then the other segment within passenger vehicles comprises CARIAD, the famous and little successful software arm of VW Group, which has become quite famous due to lack of delivery, unfortunately. Then also the battery business is grouped into this segment, and then there are some other things we'll be discussing a little later. So if I zoom out a little bit, you can see a bit more clearly the overall performance of these four segments. First key observation is that only 3 of them actually generate relatively consistently operating profit, while other is mostly a cost center. So we focus first on the most recent quarter, second quarter of 2025. You can see that the vast majority of operating profit came from the core brand group. So VW, Skoda, Seat, VW commercial vehicles, and the premium brand group, what VW calls progressive, actually contributed only a relatively small fraction of the core brand group. Even though one would assume that these premium brands, Audi, Lamborghini, Bentley, and also Ducati is a premium motorcycle brand, would bring in potentially meaningful operating profit. It is not the case, as you can see in these numbers. And when you look closely, this is quite a dramatic shift over the last few years. For instance, in 2022, you can see down here the year number, total operating profit in the core segment was 4.3 billion, and progressive was almost double at 8.2 billion. So significant outperformance of the progressive brand group, but this shifted dramatically over the last few years. In 2023, core already exceeded progressive 7.8 billion versus 6.8 billion, and then the performance delta kept increasing. 2024 core 7.5 billion, progressive only 4.2 billion, and so dramatic year-over-year declines, as you can see on these numbers. In 2024, progressive was down 38%. After it was down in 2023. 18%, and then first half of this year, even though this is already a very weak comp, progressive is down another 45%. And then when we look at core is down only 0.2%, it means it's flat year over year. And also importantly, we can see that in the second quarter, it's up 69% compared to the quite weak second quarter of last year. So we can see here some positive trend, while progressive is down 64% year over year, and only brought in a seasonally stronger quarter, the same as it did in the first quarter, 0.6 billion in operating profit. And then so we already identified now within the passenger vehicle segment, the main segment within automotive, that year over year, 1 billion operating profit loss was driven by the Progressive brand group, but weakness continues, and the weakness continues in the Sport brand group, which, as I said before, is Porsche. There's nothing else in here, and that brand group operating profit decreased by 1.6 billion. So in other words, even though core did well, it increased by 1 billion, it could not offset this substantial decrease in Progressive and Sport. So in summary, VW's, let's call it bread and butter business, high volume vehicles at affordable price points to most people, does okay, but the premium offering is significantly hurting. But then it continues when we look at other, which mostly generates losses, again comprises the quite weak software arm of VW CARIAD, and then the battery, the quite underperforming battery business and other things you can see is on the numbers. This actually, by reducing losses year over year from 0.8 billion to 0.5 billion, actually provided on a year over year basis a relief of $500 million. So in other words, we now pinpoint exactly what's going on. So significant weakness in Progressive, but the primary weakness on a year-over-year basis is actually Porsche. Because the year-over-year, from a second quarter perspective, operating profit loss was the largest in Porsche. And I think this dramatic underperformance of Porsche is part of the reason why VW Group CEO might be losing its dual role, because right now he's not only CEO of the group, but also kept his Porsche CEO position. I think that's crazy and should be changed, but it also demonstrates significant effects of politics in VW Group, which has a very highly political shareholder structure. But I can't dive into this topic here because that would make this video way too long. Now we talked so much about all the things that are not doing that great right now in VW Group. So maybe let's talk about things that improved. So let's focus on the core group for a moment that did improve year over year. So this is what this breakdown does. So this is the core brand group within passenger segment. The passenger segment is within automotive, and VW Group comprises of automotive and financial services, just so you understand how this breaks down, where it sits. And the core brand group comprises of the Volkswagen brand, Skoda, Seat Cupra, VW Commercial, and what VW Group calls tech components. And when we look at this, and I will zoom out a little more, you can see that the number one year-on-year improvement came from Volkswagen brand. So in the second quarter of last year, that brand only generated 0.2 billion in operating profit, and then increased to by 0.9 billion to 1.1 billion second quarter. Then there was a moderate year-on-year improvement in Skoda from 0.7 billion to 0.8 billion. That made Skoda the number 2 largest operating profit contributor in that segment. But then the rest is a bit of a mixed bag. So Seat Cupra brand generated 0.2 billion last year in the second quarter, and now it doesn't even round to 0.1 billion, so they lost 82% in operating profit year over year. Then we see a similarly dissatisfying picture in the VW commercial segment, decrease from 0.3 billion to 0.2 billion, 30% decrease. But overall, it's a smaller segment in terms of operating profit. And then the tech component segment also decreased 30% year over year to 0.2 billion, similar size operating profit as VW commercial. So big picture, the strengths of the core brand group was almost entirely driven by the Volkswagen brand. Skoda, some slight improvements, but the rest not so much. Now I'm just moving back for a second to the overview of the passenger vehicles segment. And so we talked about core, progressive, sport, and then there's other. And now let's dive into other. So this is what you see here. So again, other comprises CARIAD, the battery segment, and other. And you can see the primary driver of year-over-year loss reduction. So here loss reduced from 0.8 billion to 0.3 billion was actually not built on underlying performance improvement, as you will see in a second, but by other within other. So other is basically all the non-material businesses, and this often captures all the one-off items, and you can see by the volatility of this segment, this is basically driven by various one-off effects in a quarter. It's basically the, let's call it catch-all bucket from an accounting perspective, and you can see that segment within that segment had a 0.6 billion positive contribution, but you can see this is highly volatile. So this means the improvement in the overall other segment was likely a lucky outlier for VW Group in the second quarter. You can see the battery business within other is still substantially underperforming. 0.4 billion losses in the second quarter. That is up over 300% from 0.1 billion losses in the first quarter of last year. Then when we look at CARIAD, the software arm, losses reduced to 0.4 billion, but this is not driven by fundamental performance improvements. We know from media that VW Group is significantly cutting back on that part of the business. Losses, I think, were just too high for too long, and I think VW Group kind of not gave up, but changed its strategy, I think is the better way to phrase it. And one thing they did they did a JV with Rivian, of course, last year. That was announced in summer of 2024. VW Group will be spending, depending on how you count equity and debt, over 5 billion on that JV. But since VW Group will get a stake in Rivian, the actual spend is closer to about 2 billion. But the point is, VW Group is diversifying with partners, and another significant R&D, research and development partner that will provide certain software products is also XPeng. XPeng is a Chinese, up until recently, pure play EV maker. But it will be interesting how this is turning out, because XPeng is increasingly pushing into Europe. They just announced, for example, opening of an R&D center in Munich, and have significant expansion plans in the near term in Europe. So bottom line, this here at the top is year-over-year improvement in losses in this other segment is likely driven by one-off factors, and therefore made the reported total operating profit a little better than what the underlying performance would imply. So before we move on further in the income statement of VW Group, let's just quickly summarize what we learned so far. About 1/3 of VW Group is financial services that are driven by the automotive business, but at least in a short term do not correlate with automotive returns. Then within automotive, a little over 2/3 is the passenger vehicle business. Within the passenger vehicle business, the premium brands, they all significantly underperformed. The brand that saw material improvement year-over-year in the second quarter is only the primary brand, which is the Volkswagen brand. The other aspect, we learned that the top line revenue growth basically stagnates and in real terms decreases, and while operating profit significantly decreased. So in other words, revenues are not growing, but costs are expanding. Next, we look at what this meant for the shareholder, and what you look at now is shareholders' net income to shareholders in the VW Group. And the net result was that in the second quarter of 2025, VW Group shareholders had to accept the 6th consecutive quarter with year-over-year net income decreases. Second quarter was down 30%, and that comes after the first quarter was down 43%, and that comes after the fourth quarter was down 31%, and that comes after the third quarter of last year being down 69%. The tiny bit of good news for shareholders in this, let's call it somewhat negative trend, is that that for the current quarter that is being reported in a couple of weeks, the year-over-year bar is quite low. VW Group only, in quotes, has to bring in 1.3 billion operating profit, in shareholders' net income, to meet the very low last year bar. First half is down 37%. So next, let's zoom out a little bit to get a sort of a higher level perspective. Now we look at a trailing 12 months shareholders' net income metric that smooths out a lot of the quarter-to-quarter volatility. So this chart shows you the trend over the last 7 years, and so it captures the COVID period, or the COVID trough, especially in 2020, and then the recovery in 2021, and peak earnings years that were generated by these what I often refer to COVID windfall profits, which, as explained, were caused by two growth drivers: selling to customers or satisfying the real customer demand, plus the replenishing of dealership inventory effect. What I have to point out, these earnings. So the one thing to point out is that when you look at these numbers, because it's a very long time series, 7 years back, when you do something like that, you should always inflation adjust to get a better kind of baseline. And you can see that on that basis, in today's dollars, earnings came down to 9 billion from and this is an all-time peak number, from 23 billion. Or in relative terms, earnings came down 61% from peak. The other interesting observation is that at inflation-adjusted dollars, at 9 billion over trailing 12 months, VW generates earnings that are just a little bit, let's say, over the absolute low during COVID, which was like an exceptional event, led to shutdowns of factories and haltage of product sales in certain areas due to supply issues, a lot of other things, and customers not going out shopping for cars, and a lot of other aspects. There was like really a combination of a lot of really bad things, and the fact that in the current environment where there's not really a recession, there is not really any big force majeure event going on anywhere, shows you there are very severe structural issues in the company. And these structural issues basically caused VW Group to become, despite its quite substantial size, to become uncompetitive against many other companies, smaller companies, that keep taking market share from the group. And please keep in mind, if you're thinking right now, oh yeah, because VW is a German company, they have much higher labor cost. No, this is not true. Or at least it's mostly not true, because VW Group has also a highly localized production. For example, virtually all VW Group cars in China are made locally with Chinese partners that pay at, or in certain cases below, industry norms. So VW Group certainly has no labor cost disadvantage in China. But the reality is that when you look, for example, at the vehicles VW sells in China, China-made, with partners like SAIC or FAW. And if you test these vehicles, which I have, you can see they are simply not at quite the level of the competition. There are a number of reasons for it, but unfortunately, going into these would significantly exceed the scope of this video, so I might cover this in a future video. But the bottom line is the company just became too slow to adjust, and therefore is falling behind progressively. For example, right now in the very important fully electric vehicle segment in China, there is no VW product, and this also includes products from the JVs, from the joint ventures, that is anywhere near the top-selling vehicles. And this despite the fact VW only a couple of years ago, with its joint venture partners, was the clear number one in China. But so analytically, VW is effectively a Chinese automaker in China because everything is made in China. But just like other legacy Chinese automakers, they failed to adjust. So VW is declining just like the other legacy Chinese automakers like SAIC, FAW, GWM, Great Wall Motors, GAC. And their slowness or lack of innovation then created an opening for smaller, and in some cases much younger companies to take substantial market share. But let's move on, since there's a lot more to discuss. Next, we look at where the rubber really hits the road, and this is free cash flow. Over the long term, this is the ultimate metric for any company. Free cash flow tells you how much cash the business generates after it invested into keeping the business going. And that is very important, especially the latter part, because every business could significantly boost in the very short term free cash flow, but just terminating all investments and just collecting all the cash from its existing product. But of course, after a relatively short period, all the cash flow would dry up if it wouldn't invest. So ultimately, what the only thing that matters is the free cash flow, and the word free in cash flow. The word free in free cash flow refers to the fact that you need to invest to sustain the cash flow. Because the reason why we look at free cash flow on a quarterly or yearly basis is not to see, oh, how much did they generate? No, it's really to have like a idea based on actually delivered numbers, what the company could deliver in the future. That's really what that analysis is driving at. And on top of that, free cash flow analysis also shows us a clearer picture of the business, because a lot of things can significantly boost in the short-term profit and loss metrics, like operating profit or shareholders' net income, because things like depreciation and amortization can kick the can down the road for quite some time, but free cash flow adjusts for all of that. And that's why it's the king of all metrics in an automaker and over the long term in every company. And when we look at VW Group's free cash flow, what we can see is quite disturbing. So in the peak years, and I should point out the 2021 number you see here at 29.9 billion, that included a material one-off. But then you can see that from end of 2022, the sort of the cash flow boom era was over. And then when you actually add up all these quarterly cash flows since Q4 2022, the total is actually a cumulative net negative of 2.7 billion. This means from today's perspective, this reported second quarter of 2025, over the last 11 quarters, so almost 3 years, VW Group lost 2.7 billion in cash. So all the millions of vehicles they sold over this period and everything they did, including financial services, everything combined did lose 2.7 billion in cash. So people, including myself, always talk about Chinese automakers. They are selling vehicles at a loss. They just try to steal market share, etc. But the reality is that VW Group does exactly the same thing. They sell vehicles at a price where ultimately, all things considered, they don't make money. And this is just to keep their significant size. And as you saw earlier in this presentation, the periods that you see in front of you, the revenue in the beginning of this 11 months period, revenue was still increasing and then basically remained flat. So you can see VW objectively, verifiably, or whatever word you want to use, engaged in the exact same method. Then, of course, a lot of people say, yeah, but the Chinese get a lot of state support. That is true, but so does VW. VW also gets a ton of state support, especially in Germany. But that's, of course, no surprise. VW Group, all things considered, is potentially the top employer in Germany, especially if you consider the multiplier effect of every automotive job. If you ask, but who gets more state support? Frankly, I think nobody really knows, because that type of granular data is not available. Because you should keep in mind that all the vehicles VW sells in China, which is quite a lot through the JVs, these JVs get also most of the subsidies the pure Chinese maker get. Then we zoom out a bit and look at a very long-term perspective on a trailing 12 months to get rid of a lot of the volatility, we can see that VW Group has been for a very long time on a cash flow basis a very weak business. So the two, or I should say 3 big events I should point out in this time series is number one, 2015 Dieselgate, which led to very large payouts in subsequent years. And then knock-on effects, certain negative repercussions in terms of demand, although that was significantly less than what a lot of people expected. Then, of course, one has to talk about COVID. That was in 2020, but you can see during this time, cash flow actually exploded because supply shortages, etc., enabled premium prices and a lot of other things, which actually turned out being cash flow positive. On top of that, VW Group sold in a large stake in Porsche and collected 10 billion euro. And I have to, at this point, applaud my ex-colleagues at Goldman Sachs who executed the deal. They picked the absolutely perfect timing for that IPO. Not a month earlier, not a month later. A little after the IPO, this was the absolute peak of Porsche. This is what you want to have, and then it went down. If they had waited a little, just 1 quarter more, the trade-off between perceived shareholder perception, because you IPO and then immediately performance drops, would have been quite enormous. So they made the right call. They IPO'd at the perfect window, because in the next quarter Porsche's performance was still strong. So this would mute basically this or would significantly reduce investors' disgruntlement. And then quickly thereafter it was just quarter over quarter down, basically going down. So absolutely perfectly timed IPO. So congratulations. Stock peaked about 6 months after the IPO and then basically came crashing down. Porsche's share price is down around 65% since peak, and Porsche is even down about 50% from the IPO price. I did warn shareholders at the time to be very careful, because the Porsche performance is not sustainable, because also Porsche benefited from some lingering COVID effects, and the situation at the time in the used Porsche market were also not sustainable, where basically certain Porsche models, if you got an allocation, you could purchase and then resell at a very high premium quickly thereafter. That drove artificial demand for fully spec'd, very high trim Porsches. That still exists, but to a much lesser degree, but ultimately is not a sustainable situation over the long term. The only outlier to this is Ferrari, but Ferrari plays in a completely different league than Porsche, because the average Ferrari sells for roughly $500,000, and the average Porsche sells at a fraction of its selling price. And I think that was the primary mistake people made when they looked at Porsche. They always looked at the Ferrari comp. And I remember a certain investment bank made this mistake knowingly or unknowingly and compared Porsche brand with Ferrari. But he ignored the fact that the average Porsche customer is in a completely different segment from the average Ferrari customer. Most Ferrari products, all Ferrari products are not cars, they are status symbols. Porsches are also status symbols, but they still provide a transportation function. And while Ferraris compete with condos, boats, and other such luxury items, Porsche still competes with a lot of other brands' higher or premium offerings. But I digress, so let's move on, or let's look back at this long-term cash flow chart. You can clearly see that let's call it the 2001-22 era was a complete outlier in well over a decade. And VW Group was always just selling cars at a level to sustain its large size. And the big picture, if you think about a business, you only really have a business once it generates free cash flows. If you have a business that consistently generates negative free cash flow, the business is not really a business. It's really more comparable to a charity. But I think in VW's case, this is really a reflection of the complicated and highly political shareholder structure of the company. At this point, VW mostly serves to sustain the employment base in certain German states, which have a stake in VW, plus ensure that the offspring of the Porsche family and Piech family are being taken care of. And this shareholder group comprises several dozen members, so it's highly diffused. Then there is the significant employee participation, further diffusing shareholder impact, which leaves the little true free float with hardly any influence on the company's direction. So people looking at this cash flow chart will criticize, you should not be looking at total group free cash flow, because this includes the substantial financial services arm, and financial service business can create a lot of not that meaningful cash flow impact. That is correct. And that's why we need to look also at the automotive business, pure cash flow. This is what this next chart shows you, but this all things considered paints a very similar picture. You can see that the first half of 2025 only brought in 4.3 billion in free cash flow. The second quarter was down 58% year over year to 2.3 billion. The full year of 2024 was down almost 32% year over year to 17.1 billion after we saw the peak in 2023. Next, we need to look at capital expenditures, and what you see is capital expenditures in the automotive business, which accounts for virtually 100% of VW Group's capital expenditure, or short CapEx. And you can see that expenditure has been increasing quite a bit. 2022, it was up 21% year over year. 2023, up almost 13%. Last year was up 18% year over year. And then year to date, it's up almost 7%. The primary driver is VW Group's transition to more electrified vehicles, so a greater share of fully electric vehicles, but also hybrid electric vehicles. When we smooth this out by looking at CapEx on a trailing 12 months basis, you can see clearly this trend. And what you can see is in fact a acceleration in recent quarters. Over the last 12 months, VW spent an all-time record of 18.5 billion in CapEx. So the company is investing quite heavily. But on a relative basis, this is actually not that much. For example, a company like Tesla spends about 11-12 billion in CapEx. And given that VW Group generates about 3.5 times more revenue than Tesla, you can see that Tesla invests a lot more in the VW Group. And this goes back to the point I made earlier. VW Group does not expand very much its infrastructure. It really upgrades existing infrastructure with certain exceptions, and a lot of these upgrades are more limited because VW Group can for example, reuse land or certain infrastructure, etc., lowering the overall cost. And of course, the business is not really growing. That's why overall there's significantly less upgrade need, except for, of course, the transition to electrified vehicles. So then when we look at this on a relative basis, when we look at the CapEx intensity, this is defined as trailing 12 months capital expenditures divided by trailing 12 months revenue. You can see that this uptick in CapEx spend is also reflected in this relative metrics. It's more meaningful, and VW Group currently spends a record 5.45% of total revenue on CapEx. Next, we need to talk about an important accounting difference between automakers reporting under US GAAP and IFRS. So IFRS is the standard that is mostly used by European automakers, but also certain Asian automakers. And compared to US GAAP, even though it also exists under US GAAP, IFRS reporting automakers move in many cases a very significant share of their R&D spend in a quarter into the future. And the way they do it is they use what's called capitalization of R&D expenses. So they put some share of the in-quarter actual R&D spend onto the balance sheet as an asset, and then they write off this asset. So over time they recognize the spend that was incurred in a given quarter. That results in the reported R&D spend in all future quarters to comprise of two elements. Number one, the share of the R&D spend incurred in the quarter but also recognized. And let's just use some numbers. Let's say they spend 100 million euro, or let's call it 1 billion euro in R&D in a quarter. They capitalize 50% of that. That means they move 500 million into future quarters. So they will recognize 500 million of that 1 billion spent in the quarter, but then they also will recognize in that quarter from former quarters the capitalized R&D spend. So there might be, let's say, another 700 million from prior quarters. So what you see in the income statement will be the 500 million recognized from the actually incurred 1 billion in the quarter, plus the 700 million accounting charge from prior quarters. And so you will see a 1.2 billion R&D spend in that quarter. And as long as the business is growing and expanding, that is actually an advantage because the recognized R&D spend is lower. But when things start to slow down and the company cuts back on R&D spend, the recognized R&D spend might actually then be significantly higher, because then what I often call the sins of the past come and bite you, because these old incurred costs then are being recognized in the accounting amortization. So when you compare profitability of automakers, I recommend to always adjust for these significant accounting differences. And this is what this chart does. So in this teal, or called dark blue color, you see a reported operating profit. So in the first quarter of 2022, this was 4.1 billion. This is $4.1 billion. And the adjusted operating profit, so recognizing fully what they actually spent, the operating profit would be lower at $3.7 billion. And this chart proves what I said earlier. This R&D spend amortization, or should call it capitalization, so pushing it into the future, provides a long-lasting accounting benefit. It results in higher reported numbers, as is evidenced by the fact that the adjusted operating profit here is always lower than the reported operating profit. Again, this will flip once the company starts cutting back, etc. And then all of a sudden the reported operating profit will be depressed by the high incurred former R&D spend. Then when we look at this on a relative basis, on a margin basis, we can also see there's quite a substantial improvement from this accounting effect. So the company reported 4.7% operating margin, but adjusting for this R&D accounting thing, the operating margin would be only 4.3%. So that would be a loss of roughly 40 basis points. That is quite meaningful. And as you can see in certain other quarters, that effect was substantially greater. For example, if we look at the first quarter of 2023, the reported operating margin was 7.5%, but adjusting for this R&D effect, it had been only 5.8%. And when you look at these adjusted operating margin numbers, you can see VW Group has been for several years highly underperforming, because these are not acceptable operating margins. Just to put this into perspective, at the moment, the average S&P company has a 14% operating margin. And next, let's take a look at R&D expenses. So the company reported $4.94 billion in the second quarter of 2025. And that is slightly lower than the second quarter of 2024. But what is more interesting is what they actually spent in the second quarter and not what they recognized because of this accounting stuff. And this is what you see here, and this is why I said earlier, these sins of the past at some point come back and haunt VW Group, and this is what you see on this chart. So this is what they actually spent on R&D in the quarter, and you can see they spent $5.36 billion, but that number is down almost 7% year over year from 5.76 billion last year. And when you look at the quarters before the second quarter of 2024, you can see that actual R&D spend has decreased quite substantially. In fact, when you look up here on a year-over-year basis, our actual R&D spend is down year-over-year for the last 4 quarters consecutively. So the company is significantly cutting back on R&D. I think this is at least partially driven by VW Group's Rivian investment. So the Rivian investment was announced at the end of the second quarter. This means VW Group at the very minimum was in serious discussion in the first quarter of 2024, but most likely even already starting at the end of 2023. And because the company did not know whether they could make the deal with Rivian, so they kept R&D going internally. But then as the deal was agreed, they then started significantly cutting back on projects, etc. And I think this is what you see in this development. They likely eliminated duplicative projects, i.e. projects that are covered, that would have been covered by both the Rivian JV and internal VW projects. So then when we change this R&D expense trend into a trailing 12 months metric to get rid of the quarterly volatility, you can clearly see this trend. So at the peak, that was in summer of last year, coincidentally with the Rivian announcement, VW spent 24.5 billion. So this is actual spend, so it's not accounting recognition, so actually what they spent. But then in every quarter thereafter, R&D spend decreased. So I think this is clearly indicative of a change in strategy. Under the new CEO, VW clearly moved to sourcing R&D more from partners than under the prior CEO. And this trend not only reflects the Rivian JV, but also the XPeng JV, which actually preceded the JV with Rivian by roughly a year. And this is also a JV that recently VW and XPeng announced they would expand to other areas of technology development. So rather than keeping the level constant, VW is actually doubling down on that strategy. Strategically, big picture, I view this development as a further sign that VW Group is increasingly scrambling and has actually has a lack of confidence in its own capabilities to compete with other companies. Then when we look at R&D spend on a relative basis, this is what this chart shows you. So this is actual last 12 months R&D spend divided by last 12 months revenue. You can see VW keeps dialing back its own R&D intensity in the second quarter, or I should say as of June 2025. So in the trailing 12 months up to and inclusive of June 2025, the R&D ratio has decreased to a long-term low of 6.03%. I think this is clearly indicative of the shift in strategy that I just explained. And then when we look at the investment ratio, so the investment ratio combines R&D spend and capex, so it's the sum of R&D spend, actual R&D spend, and capital expenditures, and that sum is then divided by total revenue. So in another word, as the name already implies, it's the total investment amount, because investments not only comprise investments in factories, tooling, equipment, but also in R&D, because you also need to have the technology that you then can make to keep the business going. So this is a much more meaningful ratio, and we can see that is still quite high, but as you can see, there was a shift in allocation. So VW is more moving to, let's call it the infrastructure part of the investment equation, and leaves the R&D part more to other companies. So it's, I think, shifting its focus on where it's stronger, and it is manufacturing. Because as a very large global vehicle maker, obviously VW's strength must be in manufacturing, supply chain, and things like that. But technology development is clearly not VW Group's strong suit, as based on what they delivered over the last couple of years in terms of the competitiveness or lack thereof of their products. So that's almost the end of this video, but I think it's good to kind of just see where we're at in terms of share price, because my content is aimed at investors. So at the moment, VW Group trades at €102.80. That is not far off from the last 12 months high that was reached just before the kind of a global tariffs war that led to a market trough in April. I think the recovery is a combination of two main things. Number one, there was a very strong market performance since the April trough, S&P at all-time highs, and also stock markets overall quite bullish. VW trying to mitigate the blow from tariffs by substantially increasing investments in the United States and localizing more of its production. Company is currently valued at 52 billion euro. I think what keeps the company at its level is the fact that it's a dividend payer, and that it trades at a rather low multiple of 6.2 times on a trailing 12 months basis. So I think a lot of people speculate on or bet on that if there's only a slight improvement in operational performance in this giant company, and the fact that it's trading at such a low multiple, that there should be some potential for share price appreciation. Or looking at it from a different angle, that there is less downside at the current valuation. Another way you can look at VW Group's valuation is if you kind of break it apart. As we looked at earlier, there are various components, Volkswagen, Seat, Skoda, yada, 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 Audi, Porsche. You could argue that that if you, for example, just look at the value of VW Group's Porsche stake, which is about 30 billion euro, if you remove that from the 52 billion euro group valuation, effectively VW Group excluding Porsche is valued at only 22 billion euro. And I think this is a one way how many investors will look at VW Group. So my current view on the stock is that since number one, I see a lot of structural issues in the company. I don't consider the management as very strong. Also, there is no strong shareholder behind. It's highly diffused, it's highly political. This all bodes quite poorly for the company. On the other side, global company, global footprint, diversified product portfolio, various revenue streams, yada, 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 enormous size. So if there is some improvement, there's significant potential for earnings uplift, but fundamentally because of the management, the shareholder structure, and also the enormous competition I see in the industry, and significant changes to the global auto industry, especially from soon impacting autonomy. I have a fundamental bearish outlook on the company. For this reason, I would not go long in this company, but equally because the multiple is very low, and because VW Group is so important to European employment base, especially Germany, and therefore the chance of, let's call it favorable policy making is relatively high. I would also not short the company in the current environment. So the big picture is I will keep monitoring this company and will decide to make a move if things get too far out of range. This can be both to the up and downside. In VW's case, right now, I think there's no immediate need for action. But as you can see on this long-term chart, the company at times got significantly ahead of itself. These were great opportunities, and for example, I was heavily shorting company in this period because the one-off COVID effects were clearly not sustainable. And contrary to a lot of people, I did not believe that Diess, who came from BMW, I actually met Diess in my prior life, was not the right leader. Let's put it this way. And VW was riding on kind of a hype wave that was not supported by the products they actually put out. So I hope this was informative. I'm sharing this currently exclusively on YouTube because at the moment I cannot use my X account. Otherwise I would have shared this video exclusively with my subscribers. Thank you very much for listening. See you in the next one. Bye.